Hi everyone, this is Himanshu Prajapati. I'm a sustainability consultant, Sustanium. Welcome to the Navigating Net Zero session, the first session of the Navigating Net Zero, where we are going to talk about the carbon accounting for your organization. We're going to talk about some key concepts and definitions that are very important before somebody starts compiling the carbon emissions or rather start accounting for their carbon inventory. So let's talk about carbon accounting. In a nutshell, carbon accounting is a process of measuring and tracking greenhouse gas emissions which are produced by an organization, a project, or an activity. Of course, I mentioned greenhouse gases when talking about carbon accounting. It is primarily because it's the same thing. When we talk about greenhouse gases, we are essentially the same thing as talking about carbon accounting. These keywords are many a times used interchangeably. So, for an example, carbon accounting, carbon inventory, emissions inventory, or carbon footprint are one and the same thing. What we are essentially doing is we are trying to account for the greenhouse gases that are emitted by your activity or the organization's activity and convert them into CO2 equivalent. So you will hear about this a lot during the carbon accounting process. So CO2e is what we usually consider. Of course, CO2 is not just the only gas which is responsible for greenhouse effect, but there are other gases which are naturally available. These are carbon dioxide, methane, nitrogen dioxide. There are hydrogen fluorocarbons, there are PFCs, the sulfur hexafluoride, and nitrogen trifluoride. So these are some of the gases which are identified by the GHG protocol and were initially identified in the Kyoto protocol to be on the basis of which GHG protocol has been developed. Now let's briefly talk about the greenhouse gas effect. We've all studied about it during our school times. Greenhouse gas, basically, these are the gases which help trap the sun's energy so that the earth becomes hospitable, and that is essentially why life on earth is there. However, what has happened since the industrial revolution, that the concentration of these gases have increased a lot, and which has resulted in the global warming, and that is what is triggering climate change. Now briefly talking about the various gases. So of course there is CO2, methane, nitrogen dioxide, CH F3, one of the examples of HFCs, SF6 and NF3. So you can see that I've listed down the global warming potential of these gases. What these essentially mean is that 1 metric ton of CH4 is almost equivalent as 25 metric ton of CO2. That's the global warming potential, and that's the interchangeability that we are talking about. This is done primarily to convert all the emissions into one category. So for example, so basically anything that we are measuring in terms of methane is converted into CO2 equivalent, and that is what we used for the industry to understand, because that's just one metric that we have to track. It is also important to understand that these gases, although these are naturally occurring, but they are not as stable as carbon dioxide, and which is why carbon dioxide is used as the measurement unit here. Now that we have established that why whether greenhouse gas and carbon accounting are the same, let's talk about why carbon accounting is very important for us. Considering the environment that we are today, the regulatory environment, as well as whatever is happening in terms of climate change, it's very important to assess an organization's environmental impact. And for that, carbon accounting becomes really important. When you do carbon accounting, it provides a clear picture of the organizational environmental impact. It helps in making decisions when you know that the emission, let's suppose, say for your scope 3 or scope 2 is more, then you'll target those kind of emissions in terms of identifying the reduction initiatives. So that's very important before. So it's very important that you account for the carbon that you have before you embark on a journey of, saying that I'll reduce this much emission over the next 5 years or 10 years or 15 years, as many companies and as well as nations are targeting for. As we see that many countries are mandating ESG reporting, and carbon accounting is one of the building blocks of ESG reporting, it becomes very important for organizations to account for their carbon. Essentially, what carbon accounting does is support transparency and accountability, and it also facilitates compliance to local and as well as international regulations. So for an example, in the EU, it is CSRD, which is taking a lead. Globally, we talk about compliance with GRI, SASB, as well as standards on which these are the ESG reports or sustainability reports are released. But there are many other mandates which companies have to meet globally as well as locally in order to meet their sustainability goals. Lastly, of course, sustainability reporting or ESG reporting, as they say, is the building block to enhance the corporate reputation and stakeholder trust. So it's become increasingly important, and you'll see the trend across the industry that companies are bringing out their ESG reports and sustainability reports, and every year they kind of improving it such that the investors, the users, all of the stakeholders which are part of the company are very well informed on the company's initiatives, and carbon accounting is on the very building block of these sustainability reports. All right, let's quickly talk about the various emissions, because we've already mentioned that the various types of greenhouse gases which are responsible for the emissions. But these emissions can definitely be categorized into two types of emissions, which is direct and indirect emissions. When we talk about direct and indirect emissions, we are basically talking about the organizational boundary of an organization. When we talk about direct emissions, these are emissions which are due to the activity which is in control of the organization. So for an example, if you're burning fuel which are on your site and generating power through diesel generator or any other equipment, any fuel which is used in the vehicles which is owned by the company, or any fuel which is burned for any activity in the building that you occupy. So these are called as direct emissions, whereas indirect emissions are those for which you do not have a direct control on. So for an example, when you talk about purchase electricity, although you are utilizing that particular electricity, you're not actually generating it, you're not in control of the type of fuel which is being used to generate that electricity. So it is happening outside the organizational boundary, and that is why these are considered as indirect emissions. Then there are business travels, which is also outside of your control. And of course, if you're leasing the building, both upstream and downstream, when you say leasing of the building, it could also be something that you have leased a building for your operations, or you're leasing the building to someone as a real estate company. So both of these are covered under the direct emissions. So it's very important that people understand that we have to account for both direct and indirect emissions. And what happens is many a times you see that the indirect emissions, which is consisting of scope 3 emissions, many a times take a very large portion of your emission inventory. In fact, many a times going upwards of 60 to 70% of a company's activities. So I've already mentioned scope 3 emissions and wonder what is scope 3 emissions. So basically all the type of emissions can be converted or rather categorized into scope 1, scope 2 or scope 3 emissions. As I've clearly mentioned, the direct emissions, which is scope 1 emissions, which are direct activities of the companies which are in the company's control, which is at the facilities, company owned vehicles. These are something which are accounted in scope 1 emissions, whereas scope 2 emissions is indirect emission due to purchase electricity, and then scope 3 emissions are the ones which are part of your value chain. So anything that happens upstream, which is upstream activities, as well as downstream activities. We took one of the example was leasing of assets. When you say leasing of asset, it could be both leasing when you are leasing it to someone else, that could be downstream, or you're leasing from someone, that could be upstream. So all of the value chain activities are part of scope 3 emissions, and which is why I said sometimes accounts for around 70 to 80% of a company's emissions inventory. Now let's talk about the principles of carbon accounting. Of course, having understood that these are the type of emissions, it is also very important that an accurate carbon accounting is done for an effective emission reduction strategy, because that's the next step that we're going to take after doing the carbon accounting. Basically, the right carbon accounting helps the company in identifying the major sources of emissions and prioritizing the actions. So for an example, if your business travel is your largest emitter, then probably that is where you're gonna focus all your energy in terms of reducing emissions. So that's one of the example. Now, it's very important to understand that carbon accounting should, when we're talking about carbon accounting, it should be relevant. That means choosing the right categories. So for an example, you should understand which activities are part of your organizational boundary and which ones are not. So for an example, if you are a large food chain and you want to understand whether I'm giving franchisees to people and their emission should be part of my emission or not. So yes, they would be, but they will be part of scope 3 emissions of your scope 3 category of your emissions. So it's very important to understand the relevance of the activities and the related emissions. Also, it is very important to have, all the type of emissions accounted for. So for an example, many times companies are now including more and more categories in the annual sustainability or ESG reports, because they found out that last year they've not included a particular category, and the next year they are including it. When we talk about scope 3 emissions, what happens is there are 15 categories of emissions, and carbon accounting allows you to understand which ones of those are applicable to you or not, and ultimately you account for those emissions and then include into your emissions inventory. So completeness is very important. Next is consistency. Of course, what happens is you change the methodology from the previous year to this year because of the understanding of your company's organizational boundary, or the methodology calculation changes, and that is why it's very important for to build trust, to have consistent methodologies of calculations. This also means using the right emission factors. This also means using the right methodologies and adherence to international standards. Thereafter, it's important that the carbon accounting is transparent. That means you are able to clearly showcase what emission factors you are using, what methodologies are being utilized in terms of calculating those emissions. And this is something that's paramount. In fact, carbon accounting is done primarily such that you are able to disclose those emissions in your sustainability report or your ESG report. Last but not least, the carbon accounting has to be accurate, so you have to understand which factors you're utilizing in terms of calculating your emissions. So emission factors are very important. It should be the right year, it should be the right category, and that's very relevant when you're talking about carbon accounting. Let's quickly go through the steps of carbon accounting, because we've already covered what are the essential principles of carbon accounting. So once you are able to understand which categories are there in your organizational boundaries, that's where your starting point is. So you understand that, yes, for an example, if you're a bank or you're an investment bank, you know that you have done a lot of investment, so you have to look at financed emissions. If you are a manufacturing plant, you know that the manufacturing has to be part of your emissions. You have to know that any products which are coming into your boundary and any product which are going out of your boundary is also part of your emissions. So it's very important to understand the organizational boundary, and once you've understood those, identification of those sources are then the carbon accounting process itself becomes very easy. In fact, the first step itself helps you do almost 40 or 50% of the process. Once you are done through this, you will be able to do the rest of the process very easily. Thereafter, you select the calculation approach. So based on the organizational boundary and based on the type of activities, you will decide whether the calculation has to be based on spend or on activity based, or it can be both. So spend based is when you're talking about how much amount of money that I've invested in this particular activity, and then you associate with the carbon emissions, or you associate with the activity that you're doing and then associate with the emissions. You can also use both of these approaches. Once you have collected the data, the next step is choosing the emission factor database. So emission factor database is of course location based. So for an example, if your operation is in the US, you'd probably prefer US EPA database. If you're in the UK, you'll definitely go with UK DEFRA. Similarly, rest of nations, you'll try to look at the databases which are local to those countries. So selection of the emission factor database is very important. Also, it's very important to understand which type of activity we are doing and accordingly use those emission factors. So activities such as fuel consumption, electricity usage, travel distances will be the emission factors for those will be different for different countries. Thereafter, it is the use of calculation or calculation tools. For an example, if you're using a tool which helps you estimate the emissions of each of your locations, at the same time they aggregate or roll up the information into one parent company or a group level information you're able to extract from that particular tool, that'll be amazing. In fact, this becomes increasingly important because what is happening is many a times when you use Excel based tools or just Excel for calculating your emissions, it becomes really taxing because there are a lot of emission factors which needs to be accounted for, or there are a lot of emission sources that you have to account for, and where it becomes very important that you use a calculation tool that is suited to you and that helps you organize all of this activity, organize the data collection, organize the calculation and visualization of your emission inventory. Last but not the least, once you have calculated your emissions, it should also be able to publish the GHG report, and probably use those reports into or integrate those reports into your sustainability or ESG report. So that That's really important when you're talking about carbon accounting. And that's where probably you can use tools like Sustainium to help you generate such reports and integrate into your systems. I've mentioned emission factors a lot during the conversation, and it's very important to know that the emission factors are key when you're talking about emission calculation. And basis the location, these emission factors will be selected. So for an example, if you are in the US, you'll use the government database, which is US EPA, or in the UK, you can use UK DEFRA, but you can also use IPCC's emission factor database or any industry association or scientific literature, which would give the relevant emission factors, which probably are not published in these databases, which is a bit unlikely. But yes, there are emissions which probably are not being accounted for. It is also important to know that the emission factors are relevant with respect to the type of fuel usage, be it, let's suppose, say, usage of diesel or petrol, or as they say in the US, gasoline, or you talk about, the electricity usage. So for an example, when you talk about different states inside the US, they'll have different emission factors. So emission factor in the California probably could be less, and in some other state could be more, because let's suppose, say, California is using more renewable energy into their grid, and which is why the emission factor is lower. So it's very important to know which emission factors to apply for. Last but not least, there'll be material specific emission factors. So for an example, if you're using steel for construction of building, emission factor of steel will be utilized. If you're using aluminum for certain part of construction, then the emission factor would change. So emission factors are a very important part of your emissions calculation, and it's very important to understand which ones to use. And that's where I think Sustainium comes in. It helps you in knowing the right emission sources, knowing the right emission factors, and it helps you organize your emission inventory in a nice way. So basically, Sustainium can help you in several ways. We can provide you with tools and resources so that you can start with your journey of emission calculation and reporting. We can help you in setting up your carbon accounting system. We can help you in training and support, and also we can help you in reporting and verification. The Sustainium platform helps you in streamlining your data collection, accurately measuring the emissions through accurate emission factors, and then visualizing these on a dashboard for your scope emissions for individual units or at a group level. That's all for today. Thank you. You'll hear from me more on this particular series, Navigating Net Zero.